In just 48 hours, a single bank collapsed so fast it triggered the biggest panic since 2008.
A rough week for the banking industry.
The collapse of Silicon Valley Bank.
The second biggest bank collapse in U.S. history.
Startups couldn't make payroll, venture capitalists screamed, "Pull your money now," and one founder named Maya sat frozen at her laptop as her company's bank balance drained away in real time. This is the inside story of the $42 billion bank run at Silicon Valley Bank nobody saw coming. It was past midnight when Maya heard the Slack pings multiply. Like hail on a tin roof, each one a new question, a new fear. Is payroll safe? Do we need to freeze spending? Another message blinked across her screen. I heard Founders Fund is pulling all their money. Should we do the same? She clicked refresh on her dashboard. The numbers appeared, then stalled, then blinked back the same cold word, processing. She tried again, processing. Her co-founder paced the office floor, barefoot, phone pressed to his ear. Our investors are panicking. They're saying, pull everything out tonight. His voice cracked between disbelief and urgency. Across town, venture capitalists were packed into boardrooms, their faces lit by the glow of laptops, phones buzzing with messages from portfolio companies. What do we do? And in a Santa Clara office, Silicon Valley Bank's CEO Greg Becker dialed client after client, repeating the same three words, ample liquidity here. His voice was calm, almost rehearsed, but the reassurance fell flat. Maya stared at the cursor spinning on her screen. Her employees were texting her directly now. Junior engineers, a designer who lived paycheck to paycheck, a project manager with 2 kids. Please tell me we'll get paid. For them, it wasn't just numbers on a dashboard. It was rent, groceries, and their livelihoods. And as the digital panic spiraled faster than any line outside a Depression-era bank, one truth surfaced above the noise. When trust is broken, money quickly follows. During the pandemic boom, deposits at SVB exploded. Tech startups raised enormous rounds and billions poured into SVB accounts almost overnight. The bank had a problem most bankers only dream of: too much cash. So what do banks do with billions sitting there? They invest. SVB bought long-term US Treasuries and mortgage-backed securities. On paper, these were the safest investments in the world. Boring, predictable, but here's the dangerous math. Those securities had a hidden weakness. When the Federal Reserve raises interest rates, the market value of existing bonds falls. This isn't really intuitive, so let's picture it. Imagine a ladder of bonds. At the bottom are the short terms, 1 or 2 years. At the top are long terms, 10, 20, even 30-year bonds. SVB climbed high on the ladder, locking into bonds that promised low, steady returns for decades. Then, the Fed began hiking rates at the fastest pace in 40 years. Suddenly, brand new bonds were paying far higher interest. So why would anyone buy SVB's older, lower yield bonds when better ones were available? Well, they wouldn't. This mismatch between long-term assets and short-term obligations is called duration mismatch. And when you combine it with lack of oversight and diligence, it's about to cause a huge avalanche. Meanwhile, SVB's clients, startups like Maya's, weren't profitable, just subsisting on new investor funding, and they were spending big on payroll, rent, vendor contracts. So, as the venture funding they relied on so heavily dried up in 2022 with the interest rate hikes, startups were withdrawing more and more from the bank. At this point, money was flowing out faster than it flowed in. Maya saw her company's burn rate rising fast. She assumed the bank could handle it. It was, after all, the startup bank. But inside SVB, executives were staring at spreadsheets showing billions in unrealized losses on the bonds. To the public, Greg Becker smiled and repeated calm reassurances. SVB is strong, we're well capitalized. But inside, his team knew the truth. Those unrealized losses were cracks in the dam. They didn't matter until the water pressure forced the dam keeper to open the gates. And that moment was coming fast. On the evening of March 8, 2023, Greg Becker sat in his office at Silicon Valley Bank's Santa Clara headquarters. The walls were lined with startup memorabilia, framed photos of pitch competitions, plaques celebrating IPO clients, the kind of trophies a bank collects when it's more than just a bank. For 3 decades, SVB had been Silicon Valley's financial heartbeat. But that night, Becker's voice trembled ever so slightly as he picked up the phone. The day had been brutal. Hours earlier, SVB had announced it had sold $21 billion in securities at a steep loss. $1.8 billion gone in a matter of a few trades. Because SVB took no action when the Fed started raising interest rates, the duration mismatch of bonds forced them to sell and realize the losses. If SVB hadn't sold, the losses would still only be on paper. But now there's a gaping hole with billions of dollars leaking out, and the bank tried to plug it with bubblegum by selling $2.25 billion in fresh capital. The press release was standard, the reaction was not. SVB's stock plummeted 60% in a single trading session. At this point, we're well past a bank being simply strapped for cash. This was a collapse unfolding in real time. In full desperation, Becker went on damage control. He called his clients one by one. "We have ample liquidity," he told them, repeating the line like a mantra. "Your money is safe at SVB." The words were meant to calm, but in the startup world, calm doesn't spread, panic does, and it was too little too late. By the time Becker was on his 3rd or 4th reassurance call, a very different conversation was happening in Slack channels and WhatsApp groups across Palo Alto, San Francisco, and New York. At venture capital firms like Peter Thiel's Founders Fund, partners weren't soothing anyone. They were shouting, "Get your money out now." It began as whispers, a cautious email from a venture capital firm to its portfolio companies, then a text, "Wire your funds tonight, don't wait." And soon it was everywhere. Twitter threads, group chats, emergency late-night board calls. The message was clear: if you had money in SVB, you were already too late. For Maya, our fictional founder, it was around midnight when the Slack pings woke her. At first, she thought it was just a rumor, but then she saw the names: heavyweight investors, firms whose advice could swing billions. Her stomach knotted. She logged into her SVB dashboard. The numbers were still there. Payroll was scheduled to run Friday morning, but the words on Slack were like sparks on dry grass. If everyone around her pulled their deposits, those numbers on the screen are worth about as much as the pixel it's displayed on. She called her co-founder. "Should we move it?" A slightly too long pause. "If we don't, and the bank folds, what then? We're finished." At SVB, Becker kept dialing, hoping his assurances might slow the tide. But this wasn't 2008. You didn't have to stand in line at a branch to withdraw your savings. You just had to open an app, and within hours, billions were vanishing with the tap of a touchscreen. On Thursday, March 9th, the full run began. In a single day, depositors yanked out $42 billion, the largest bank run in U.S. history by raw dollars. For perspective, that's more than Washington Mutual lost in 10 days before its 2008 collapse. SVB hemorrhaged the same amount in less than 24 hours. Inside startup offices, founders watched their dashboards flicker. Wire transfers hung in limbo, processing. In investor group chats, screenshots flew back and forth. Proof of transfers initiated, but no one knew if the money would actually land. Payrolls were due in hours. Some CEOs even considered maxing out personal credit cards just to cover salaries. Others drafted contingency plans to furlough staff. And still, Becker kept calling. In one reported conversation, he told a client, "We have liquidity for clients to withdraw if they need it. The only exception is if everyone is telling each other SVB is in trouble, then that would be a challenge." But by then it was too late. Everyone was already telling everyone. By Friday morning, March 10th, another $100 billion in withdrawal requests were queued up. In total, nearly 2/3 of the bank's deposits were set to flee in less than 48 hours. And then, silence. Maya refreshed her dashboard again. The numbers didn't change, just one new message. FDIC has taken control of Silicon Valley Bank. For founders, it felt like the floor dropping out from under them. 94% of deposits were uninsured. FDIC coverage capped at $250,000. This was a parachute far too small for startups holding $10, $50, even $100 million in SVB accounts. For Becker, the collapse came mid-sentence. He had been reassuring clients, pleading with regulators, chasing capital, but none of it mattered. By lunchtime on March 10th, the bank he had spent 30 years building was gone. Some thought the panic was over, but the collapse sent out ripple effects through the global financial system. On March 12th, just 2 days after SVB was seized, regulators shut down Signature Bank. Setting another new record, it was the third largest bank failure in US history. For years, Signature had been a favorite among cryptocurrency firms. But crypto was already in free fall at this time after the collapse of the exchange FTX, founded by Sam Bankman-Fried, who's currently serving a 25-year prison sentence for securities fraud. One founder of a crypto payments startup described refreshing his own dashboard that weekend. His deposits weren't just shrinking, they were evaporating. And then the FDIC banner appeared. This bank is closed. He later told reporters, first FTX, now my bank, it felt like the floor kept giving way beneath us. Signature wasn't the end. A month later, First Republic Bank collapsed too. This one was even bigger than SVB. Wealthy clients fled en masse, pulling deposits from a bank that had catered to tech executives and coastal elites for decades. The headlines flashed across CNBC tickers, another casualty, confidence erodes. Stock charts turned into waterfalls straight down. It wasn't just America. Across the Atlantic, Credit Suisse wobbled too. A storied Swiss bank that had survived wars, recessions, and scandals was suddenly forced into an emergency takeover by another Swiss bank, UBS. The Swiss government brokered the deal in a weekend. Anchors on Bloomberg spoke in hushed tones, usually reserved for geopolitical crises. This wasn't just a banking problem. It was a contagion, a reminder of how tightly the system is wired together. Into this chaos stepped a man named Tim Mayopoulos. Mayopoulos wasn't a household name, but in banking circles, he was the equivalent of a crisis firefighter. Back in 2008, when mortgage giant Fannie Mae nearly collapsed under the weight of toxic loans, Mayopoulos was parachuted in as CEO. His steady hand helped stabilize one of the largest bailouts in US history. Now, in March 2023, regulators tapped him in again, this time to clean up Silicon Valley Bank's wreckage. There's a direct quote from Mayopoulos' phone call with a client saying, "Business as usual." The words are simple, but the delivery was everything. Mayopoulos reassured clients that wires were clearing, accounts were accessible, and deposits were safe. He spoke with the calm cadence of someone who had been here before. For founders like Maya, it was the first time in days she felt a flicker of hope. Her heart was still in her stomach, but at least someone was now steering the ship. Where Becker's reassurances had felt like denial, Mayopoulos' message was deliberate and measured, a counterweight to Becker's frantic collapse. The storm wasn't over, but for the moment, Mayopoulos managed something Becker could not, a pause in the freefall. In 2008, banks failed because their assets were rotten at the core. Subprime mortgages bundled into securities that collapsed under their own weight. Those failures were cancers that had been growing for years, hidden until the body finally gave out. In 2023, Silicon Valley Bank didn't collapse from toxic assets. Its bonds were safe, government-backed, the kind of thing textbooks tell you to hold forever. SVB's undoing wasn't credit risk, it was liquidity risk. A solvent bank brought down not by what it owned, but by the speed at which its depositors fled. It was the first true digital age bank run. In 1929, customers lined up around city blocks to withdraw cash. In 2008, panic rippled through mortgage markets. Then, in 2023, billions vanished with a few taps on a smartphone. And the scale was staggering. 3 of the 4 largest US bank failures in history happened in 2023. Silicon Valley Bank, Signature Bank, and First Republic. That year rewrote the record books. The dust eventually settled. Depositors were made whole, payrolls cleared, Maya and thousands of founders like her survived. In the years since, we've seen the story play out a bit further. For Maya, the lesson was simple. No more single bank dependency. After SVB, her startup opened accounts at 3 different institutions. Payroll went one way, vendor payments another, reserves split across several. "Never again will one bank hold our future in its hands," she told her co-founder. She wasn't alone. Across the valley, CFOs rewrote their playbooks overnight. Diversification became gospel. Founders remembered the panic, the Slack pings, the frozen dashboards, the wires stuck in processing. Even though their deposits were eventually guaranteed, the emotional damage was done. For Greg Becker, the story ended differently. Once the smiling face of SVB, he was grilled in congressional hearings. Congress summoned him to explain how a well-capitalized bank unraveled in 48 hours. Lawmakers grilled him over three things: his insistence, days before the panic, that SVB had ample liquidity; his decision to sell $3.6 million in personal stock just weeks before the collapse; and his flight to his $3.1 million cottage in Hawaii immediately after the collapse. For many, his legacy is not decades of building SVB, but the image of a CEO who ran a loose ship, then vanished when his clients needed him most. Tim Mayopoulos, by contrast, slipped back into obscurity with little fanfare. Having steered Fannie Mae through the wreckage of 2008, he knew the script. He told clients calmly, "Wires are processing, accounts are safe, it's business as usual." That assurance bought time for regulators to arrange SVB's sale. As the quiet fixer, he stabilized SVB's wreckage long enough for First Citizens Bank to acquire its remains. Clients were made whole, but the SVB name vanished. Mayopoulos left without a spectacle, exactly as he arrived. In Washington, the debate reignited. Should deposit insurance caps be raised beyond $250,000? After all, most SVB startups held tens of millions. Tiny parachutes were no help when they were falling with an elephant strapped to their backs. Others pressed for tougher stress tests for mid-sized banks. In 2018, regulations for banks under $250 billion in assets were relaxed. SVB fell comfortably under that threshold, avoiding the rigorous stress testing mega banks endured. Critics thought that decision left the whole system vulnerable. Banking experts pointed to the paradox. Mid-sized banks aren't too big to fail, but as 2023 proved, they are systemically important. Their collapse can still rattle the entire financial system. The panic of March 2023 was contained, but only because regulators broke the glass and pulled every alarm at once. The question remains, though, what happens next time? The ultimate beneficiary was First Citizens Bank, a mid-sized bank from North Carolina that few in Silicon Valley had ever heard of. Overnight, it acquired SVB's assets at a discount, instantly transforming into one of America's 20 largest banks. The SVB name disappeared, its iconic logo stripped from office walls. To the outside world, the crisis was resolved. But to insiders, the erasure of SVB felt symbolic. A bank that once defined innovation, gone, absorbed, its story reduced to a cautionary tale. Greg Becker testified, Tim Mayopoulos stabilized, founders survived, regulators patched the hole, and First Citizens cashed in. But the question lingers in every boardroom, every startup Slack channel, every late-night founder text. If one bank could vanish this fast, what about the next one? This situation was a perfect storm of a lack of oversight and diligence. In April 2022, SVB's chief risk officer left the bank and wasn't replaced until January 2023. This was 8 months without a captain at the helm of the risk department. The CEO, Greg Becker, was on the board of the Federal Reserve Bank of San Francisco, which ironically was the regulator for SVB, but he resigned shortly after the collapse. When the Fed started raising interest rates, red flags should have gone up all throughout SVB, triggering a restructuring of holdings. But no action was taken, and eventually it forced SVB to sell the bonds at a steep loss, starting the avalanche. Fortunately, thanks to the swift actions of regulators, SVB customers made it out mostly unscathed, and the financial system itself lived to fight another day. And that's the story of how one mid-sized bank unraveled so fast it sent shockwaves from Silicon Valley to Switzerland. If you enjoyed today's unraveling of money and greed to find the truth beneath, do me a favor, sneak into the Like Button's bank account and replace all their cash with expired Chuck E. Cheese tokens. Then, subscribe because we post stories like this every week, and you won't want to miss the next one. Thanks for watching.